The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday, 3 o'clock. If you miss an episode, you can follow me on Apple or Spotify, the Main Street Code. And you can always check out my website, themainstreetcode.com, and find past episodes and lots of other information about insurance issues. We are an independent life insurance wholesaler. We represent 30 different insurance companies, whether they're life insurance, annuities, disability, and long-term care, and we are experts in that area. We work with hundreds of advisors across the United States in lots of different insurance issues. Attorneys, CPAs refer to us when it comes to how do we do that, how do we do this, when it comes to insurance. And one of our big recommendations is that you review your insurance policies on a regular basis, because the policies change, life changes, everything changes. And with that, you want to stay up to date with all the latest changes, and products change as well. Several insurance companies have left the New York State market. And over the last 10 years, I can't tell you the number of changes has been tremendous. You know, who would ever think MetLife would actually leave the independent insurance business, as well as, ING, and, there's just been a lot of changes, particularly in New York. Last week, I happened to be in Texas for the week. I was at a conference for 150 general agencies across the United States. I was honored there to be the keynote speaker on marketing. In addition, I had a carrier that had me as their carrier champion. It was very great. One of the things that happens at these conferences is insurance companies from around the country come to these conferences to talk about all their different products and all the different things that are not just happening in New York, but across the country with new products or different products. And we meet with all the different companies to find out the latest and greatest things. And they also go through lots of different scenarios on how they help clients and situations, which is very important, because not every carrier has every product or can do everything. And being an independent wholesaler is extremely important for you as the consumer. When you're buying insurance product, you don't know if let's say a New York Life person comes to you. Well, they're very good at whole life insurance. Their term is very expensive, not very strong in universal life. They're very limited in their product and selection, just like any carrier. Or they may not underwrite certain ailments that other carriers will underwrite. Certain carriers are very good with diabetes or high blood pressure or heightened weight or dangerous activities like motocross racing and other things. So a lot of carriers are different and good for different reasons. And then this week, I happened to be in Albany. In Albany, I met with legislators and senators, New York State specific, and I'm part of NAIFA, which is the National Association of Insurance and Financial Advisors, And we had some very specific missions and some tremendous talks with our legislators. And one of the things that we're trying to do, and why it's important to you, is there are many products that are not in the state of New York that are in many other states. And some of the reasons is that we have higher expense formulas and more reserves required in the state of New York than every other state in the country, so that a lot of insurance carriers have to change or rewrite their product just for New York. And a lot of carriers have left the state of New York or have decided not to enter the state of New York because they have to change everything that they're doing to compete in New York. So that was one of the things we talked about with the legislators. The other thing is something called an interstate compact. And what that's all about is that when a carrier comes out with a product, there's 48 states that will approve it almost unilaterally, and then they need separate language for New York. So we're trying to get them to agree with the other states in accepting product, which limits our product. One of the other areas that we're proposing, and there's some bills in Congress, and we're big proponents of financial literacy. We're trying to get high schools to require a course in financial literacy, 9th grade, 10th grade, 11th grade, and 12th grade, and that as part of the condition of graduation, that they should have some sort of financial literacy. You know, we talk to kids today, and whether entering college or entering life, and they don't know what a 401k is. They don't know what an IRA is. Half of them don't even know how to write a check or know what a debit card is. There's so much that goes involved, and sure enough, understanding insurance and life insurance and disability and preparing themselves is like out of the question. So we're very big on helping us and protect you, the consumer, get you products that you need, and also make sure that we can get out to you and explain all the different things that we do with NAIFA. Very important. So again, Texas was big. That was big. And my third notice to you today is that I am in the process of basically merging or eventually buying another agency in Patchogue, and I am moving my offices to Patchogue to help facilitate that. And I'm adding a lot of value with what we do as far as our case design and underwriting, and adding a lot of products to an existing agency. So for those of you in the industry that sell life insurance, annuities, or disability, or long-term care, that you'll know that you'll have more choices and more options with Main Street Planning Group and my expertise and my underwriting expertise in what we do. So those are the notices for the week. We've been very busy and helping people. And I had an agent call me yesterday with his own particular issue that I want to go over. So he's 82 years old, and he's done very well. He still has $1 million in his IRA, and he talked to his person at Charles Schwab or where there was his financial guy and said, and he's very concerned about the market. And he's 82, and he's done well, and you know, he's tired of waking up and looking at the stock market every day. He has enough assets that he could live the rest of his life. He would like to have a legacy for his kids, and he doesn't want to run out of money, and he wants to make sure all his expenses are paid. So he had all these concerns. So what people don't realize is when you have an IRA, and that's predominantly your largest asset, and he's got Social Security, and his wife's got Social Security. Believe it or not, him and his wife are both still working. They both have jobs where they can work and do different things, and they're very content. So his concern was taking part of that money and securing income for the rest of his life. And then I go, you know, the balance of it will go to his wife, presumably, if she outlives him, which she probably will, but you don't know for sure. and then he wants to leave the rest of his IRA to his kids. Well, that IRA, leaving it to your children, is a tax time bomb, an absolute tax time bomb. Leaving your IRA to your kids today, or your nieces or nephews, can be a tax time bomb. And what do I mean by that? You used to be able to stretch out the IRA distributions or 401k distributions to your children. You can't anymore. And when we come back from break, I'm going to tell you a little bit more about that, because we have some solutions. And those solutions are what we do every day. So you're listening to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. If you want to reach out to me about any issues you have regarding insurance, or just to review what your portfolio is at no charge, I'm happy to sit down with anybody. Call me at 631-647-4694, 631-647-4694, Neil Himmelstein. We're going to be back right after this commercial break, and we're going to talk more about this IRA time bomb. Thank you. Welcome back to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein, and right before the break, we were talking about an 82-year-old agent that talked to me about he had an IRA, and at 82, it's now valued at $1 million. He saved. He hasn't spent it. He's been living off of Social Security and income, as is his wife, and they're doing quite well. And he was concerned. He had a lot of concerns about this $1 million he had sitting in his IRA, or it was an old 401k, and it's now an IRA. And his number one concern is, I don't want to listen to the market anymore. It goes up, it goes down. I don't need risk. I've done well. I'm content with where I am. The market worries me. The other thing that worries is I think I have enough money or income to support my lifestyle now, but I really maybe don't want to work anymore and just want to live off my money. And how do I do that? Am I going to run out of money? And at 82, you have ample money. And its final concern is, what if I leave this to my kids? What's going to happen? So here's how we addressed it. I said, not with all your money, but let's look at half. Let's look at $500,000. If I can give you an income, if you live to 150, a guaranteed income for life, I could do that today. And on a $500,000, it came out to about $4,800 a month. For all intents and purposes, it's like $60,000 a year. Forever. If you live to 120, you're still going to get that $60,000 a year. Think about that. What does that mean? That means that with your Social Security and that income, all your bills are paid forever. Forever. And you don't have to think about it. You don't have to worry about the market going up. You don't have to worry about going down. And you still have $500,000 in your IRA, hopefully growing. It could be in your current investments. You want to be in more stable investments, we could guide you there. But for that $500,000, we're going to create an income stream. But I want to leave it to my kids. If I did nothing and I kept everything the way it is, and he left it to his kids, let's say he left that $500,000 to his one child. Here's the problem. That is going to be completely taxable to that child. Now, if the child took it in a lump sum, he's going to have to pay ordinary income taxes on $500,000. That's huge. But the IRS used to let me spread it out so that as I took the income, I could take it out over my lifetime, but they stopped that last year or a year and a half ago with the Secure Act 2.0. So now that child has to take it over 10 years. So let's say he had to take $50,000 a year in income for the next 10 years. So his child happens to be very wealthy, okay? But that $50,000 may add to his current tax bracket of, let's say his current tax bracket's 23% federal and 8% state, whatever it is. Now all of a sudden that $50,000 is going to put him over the edge and make him, let's say, 30% federal taxes. that means all his current income and that $50,000 is going to be taxed at the higher rate. So you're really hurting him financially. That $50,000 all of a sudden becomes $30,000. So that $500,000 all of a sudden becomes $300,000 or much less. So that could be problematic. Now, if his child wasn't doing well, let's say he had a special needs child, and I want to talk in generalities for everybody. Let's say you had a special needs child that was receiving services, or maybe they're autistic, or maybe they can't fend for themselves. Well, all of a sudden, you're going to be off government services when you get this income, because they're going to take all this income and use that first before you can get federal services that currently not paying for. So you could actually hurt a special needs child by giving them this IRA. Now, let's say you're 80-something and your children are in their 60s, which is very common, and maybe they're just starting Social Security, and maybe they don't have to pay tax on their Social Security because they have no other income coming in. Maybe they're deferring their income for later. Well, all of a sudden, you're forcing $50,000 a year, let's say, in income, or $100,000 a year in income for the next 10 years. And all of a sudden, now that Social Security becomes taxable, and that becomes taxable, and they're in a higher tax bracket, and by the way, their Part B medical goes up because now you have to pay more money with your IRMA, which is your income taxes. So you could be triply taxed by doing him a favor and leaving this $100,000. So it's not efficient money to leave behind is the net result. So let's go back to this income I'm producing of $60,000 a year. You know what? He said, I really don't need all that income. I have enough assets and income to pay for myself. Well, for $50,000, even at age 82, actually it's much less. It's like $40,000 a year. For $40,000 a year, we can buy $500,000 of life insurance that you're going to leave tax-free to your children or your spouse. Tax-free. That's a lot better than $500,000 that could be subject to triple taxes. Tax-free. So you know what? Let's replace that $50,000, that $500,000 with a tax-free check to my children. Wouldn't that be better? Yeah, it's huge. Instead of leaving $200,000 or $300,000, you're leaving that full $500,000 by buying insurance to replace that asset. And you're still going to have a positive cash flow after buying the life insurance. Now, if your intent is to leave it to your kids, it's a much better asset to leave behind. You can do all of it or part of it. You could do it for an income stream. You could do it for an income stream and replace it, which a lot of people are doing now. And what a great way to transfer wealth by doing it inside an insurance contract. So here's some of the options you can do. Now, we have a person who had an IRA of $1 million, but they're 65 years old. And they said, you know what? We don't want to take this income right away. You know, at 70 and a half, now 72, there's a required minimum distribution that you have to take income. But what if we could take that $1 million and turn it into $800 for my required minimum distribution? That might be good. We could take $200,000 today and buy what they call a QLAC, which is called a Qualified Longevity Annuity Contract. And what we could do is we could take that $200,000 and make it so that it's an income payment for life, but only starting at age 85. So to the IRS, I reduce the amount that I have to take on my minimum distribution, and I can defer a lot of it till I'm 85. Now, there's another solution that's been out there for a long time, is I can convert this money into a Roth IRA so that it'll never be taxed. Like life insurance, it'll never be taxed. So let's say I took $100,000 and I bought a Roth IRA. I would pay the taxes now, but it would grow tax deferred. I could leave it behind tax-free, but I won't have that leveraging effect of life insurance. With many clients, we recommend a combination of things. It all depends on your situation. But that IRA money, that 401k money, that 403b money, it was meant to be spent in retirement. The government has given you a great deal of savings in you being able to deduct that money when you put the money in. But at some point, the government wants its money back. Is it better to be taken out at your tax bracket when you're retired or your children's bracket when they're working? You tell me. I would say, most likely, it's better if you do spend it and have some sort of plan to spend it. Now, I didn't get to everything I wanted to get to today, but we are in a generation that suffers long-term care crisis. We are really in what we call a silver tsunami, and we could use part of that income to buy some sort of long-term care insurance or a hybrid policy, life with long-term care in some situations, that will further insulate our money from taxation and leave the most behind to our children and or nursing homes. You're listening to the Main Street Code for Financial Success. I hope you enjoyed our session today. Please give me a call at 631-647-4694 or visit me on themainstreetcode.com. Have a great weekend, everybody. Hope you found this helpful. Thanks.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.